All right, everyone, this is Matt Lengel again with Denver Private Wealth Management, coming to you with the next video in our series surrounding demystifying private investments. With this specific video looking at the asset class of private real estate or direct real estate investing. So, quick recap just to speak through the private investment universe and how the private markets work. It's made up of private credit, infrastructure, real estate, and private equity. Go look at some of our other videos. It's going to dive deeper into some of those topics, while this real estate piece will look a little more into the private real estate space and how it operates and some of the beneficial pieces of that asset class. So to start, I think it's important to understand within the private real estate space some of the different opportunities or different objectives when it comes to private real estate, and that could be core plus, value add, and opportunistic. Now, this chart does a very simplified, very easy job of explaining core real estate is going to not have as much risk, but not deliver as much return. That's usually going to be, something where you're buying a stable investment. There's not a lot of rehab or work that needs to be done to the property. There's already a tenant involved. A high-grade tenant, so you know that you're going to be able to be collecting rent. While if I'm looking core plus, maybe there's a little more work that needs to be involved, but this and maybe not quite as A plus of or A1 of a tenant, but still relatively within that space. So these are going to be more sort of income producing. And then value add and opportunistic are going to be some of the riskier versions of private real estate investing, but also deliver potentially the highest level of return, and also have the lowest correlation to your public stock market. Now, opportunistic and value add are going to be looking at things such as repurposing a building or building something from the ground up. So that could look something like buying an old warehouse and ripping it down and turning it into an apartment complex, for instance. That'd be more on the opportunistic side, or value add, same idea of taking an existing building and being able to, using your capital and using your skills of adding more structures, adding capital to it to repurpose the asset and potentially deliver you a higher level of return. So when it comes to opportunistic real estate and some of the vintages, I think it's worth noting that when it comes to that value add and the opportunistic side, they're going to be a little more similar. And so I like to think it's so much of a buck in the sense of core and core plus is going to be a little more sort of income producing, and they're sort of within their own space, and then value add and opportunistic being within their own space, where you're trying to chase higher internal rates of return, looking more for that appreciation bucket than maybe that cash flow bucket like you would in core and core plus, but potentially higher levels of return if you're willing to assume that risk. And finally, it's going to be really important to understand the uncorrelated nature of private real estate. Now, there's a lot going on in this graph, but before we dive into it, I just want to remind you that if you've been following along with this series, if you read some of our previous articles, a lot of my job as a wealth manager is to find as many return drivers or return streams that I can that are uncorrelated from the other assets, the other return drivers within your overall portfolio. And what this graph is showing, so in the gray line, this can be publicly traded REITs or real estate, and the blue line is going to be direct real estate or private real estate. And the 1 to -1 here is going to be dictating the correlation. So a correlation of 1 would mean that it's going to move in unison with this case of the S&P 500 perfectly. A correlation of -1 would mean that it's going to move in exact opposite unison of the S&P 500. And what you'll notice here is that along the gray line, while it's not certainly perfectly correlated with the S&P 500 or U.S. large cap stocks, publicly traded REITs certainly are going to be, following a lot higher correlation to your U.S. large cap stock portfolio. While on the blue line here in direct real estate, you'll notice more of a historical, since 1980, negative correlation overall. And so when I look at that uncorrelated return driver and some of the returns that you can potentially get out of private real estate, this becomes a lot more attractive to us. Even more so if you notice, 3 of the main recessions here. So 1980 double dip recession. This is Black Monday, 1987 crash. This other circle, along with the housing bubble, Euro debt crisis. If we look at the blue lines here, historically, the uncorrelated nature has helped you in some of these sell-offs or recessions. And that's one of the many reasons that at Denver Private Wealth Management, we continue to be interested in the private real estate space and how it might fit into the portfolio of some of our more sophisticated investors. So, as always, I really hope this was beneficial. Please reach out to us if you have questions on how this might fit into your personal portfolio, along with any other questions of understanding the private real estate investment universe a little more. Thank you.